Welcome back. This is The Real Money Pros after a week hiatus. Actually, maybe 2 weeks. Took a little time off for the Thanksgiving holiday, so I hope everyone enjoyed that. We're back here entering into the end of the year. I'm Jeremiah Bates, joined with my colleague Nick Daniels. We are fiduciary financial advisors. Not here to sell you anything, here to strictly give you advice. You wonder what our incentive is? Well, we're a sponsor-driven program. So what we would certainly appreciate is going to the website, therealmoneypros.com. It's where you can interact with us. Use the Ask the Experts feature. Use the chat feature. We are live. So if you have a question, you want to send it through the website, send it our way, and we will get you an answer live on air. Or if you want to interact with us directly, call us. Phone lines are open. 979-59-MONEY. That is 979-596-6639. You might be wondering, hey, this is December, early December. 31st is going to be here relatively quick. I've heard a lot of things that we need to possibly look at or try to get done before the end of the year to put us in a better position as far as the calendar year looks and giving you a good springboard heading into 2026. Well, call us and you could literally ask us that question. What should I be doing? We will ask you a few questions in response to effectively arrive at hopefully some good advice that you can take some tactical steps, some logistical steps, if you will, to maybe do a Roth conversion, maybe do a qualified charitable distribution, a 529 contribution, or if you're self-employed, what movements can you make? Because the landscape opens up quite a bit when you're self-employed as far as pre-tax deferral. So again, give us a call, 979-59-MONEY. That is 979-596-6639. So let's get into this because, you know, what I like to call this the end-of-year gauntlet when it comes to client meetings. And reality is, a lot of times you do have to wait till November to December so you get an accurate picture basically of what your income looks like. So then we can start looking at, okay, what is the best movement to make as far as an efficiency standpoint, and one of which is required minimum distributions, meaning if you are of a certain age, you're going to arrive at a point where if you had money that you contributed into a pre-tax account, such as a traditional IRA, a pre-tax 401k, the IRS is going to say, you are now required to pull money out. And if you don't, we're going to penalize you. So now you could be in a position where you're like, hey, I don't necessarily need this money, meaning I have other sources of income that are feeding through. I have some other cash or other accounts that I've been pulling money from. So I understand that I need to pull this money out of my retirement account. And I understand that that money I pull out will be taxable to me, but I don't need it. So what can I do with it?
Yeah, that question comes up quite a bit. I think one of our favorite moves that we like to encourage our clients to take advantage of at this time of year with these required minimum distributions is what's known as a qualified charitable distribution. So what you're doing is you're taking your required minimum distribution dollars, let's say it's $15,000 that you're forced to take out. You can actually have the custodian send that $15,000 directly to your charity of choice. And what that does for you is two things. First of all, it satisfies that requirement to take money out of the IRA or that pre-tax 401k, pre-tax 403b account, right? It satisfies that. So you can check the box with the IRS, yes, the money came out. But the secondary benefit for you is it's a charitable donation. The money's not going to your checking account. It's going straight to the charity that you specify. So when you file taxes, you actually get a tax deduction for making that charitable donation. So if you think about it this way, and there's a lot of people out there who do, a lot of our clients who do, they think about this way. You're taking pre-tax dollars, meaning the government never taxed that income. It went into the pre-tax account. It grew for all those decades until the IRS says it's time to take it out because we're ready to get our hands on those taxes that have been deferred for all of these years. But then you're saying, oh, nope, sorry, government. You're actually not going to be able to get the tax on this because we're donating it to a charity. It's pretty cool.
No, it's a valid strategy that I would call low-hanging fruit because it's not it's not complicated at all. There are a few requirements that you need to pay attention to, but the actual process of getting it done is relatively easy, meaning whatever entity / custodian holds your IRA, they will likely have a specific form.
Correct.
Like that you'll use to show that, hey, I'm going to do a distribution out of my IRA. It's not going to me. You're not going to write a check to me and mail me a check. You're not going to send it directly to my account. I am going to designate the charity that I'm going to send it to. You submit that form to your custodian. You monitor it. Make sure that they process it. And
your responsibility is to monitor it. Let's be clear on that.
And you're going to see that amount actually leave your IRA. Here is the benefit. That money actually never hits it's excluded from your taxable income. It's not even taken into the equation. And here is why this is important. I got a number of clients who are charitable minded, meaning they're just taking cash out of their bank account and they are doing donations to a church or some type of charitable endeavor that they hold near and dear to your heart.
Yes.
That's great. I agree with the sentiment. But with standard deductions so high, it is a rare bird where you are getting a true tax benefit for that charitable contribution. So that is the benefit of the QCD. You're already making the charitable contribution as it is. So instead of sending it from your bank account, send it directly from your IRA. Couple cool things. If you're hearing this, you're like, well, I'm not of RMD age yet. 70 and a half and older. That's the rules.
Right.
Meaning the count, like in 2025, if you turn 70 and a half, you are eligible to do a QCD, which is great. Meaning it's just a nice way you have this bucket of money. You want to get that taxable benefit. Great. You do it. Now, here's where the devil's in the details. You got to make sure that on your tax return, it is in fact listed as a qualified charitable distribution. So, and there's some avenues that I'm going to take on this because there has been a reoccurring scenario for a few clients that I've met with throughout the year where I'm looking at their 2024 return and I'm seeing a couple misses. So again, along those lines, make sure that your CPA knows that, because here's what's going to happen. At the end of the day, when you pull money out of your IRA, your custodian is going to issue what's called a 1099-R. That custodian is not going to list in that 1099-R of all the money you pulled out of your IRA, that some of it was earmarked as a qualified charitable distribution. They don't. That is on you, whether you're self-preparing to make sure that is marked as a QCD or your CPA is aware of this. Keynote, the only way they're going to be aware is if you make them aware, like, hey, out of this $50,000 I pulled out of my IRA, 10,000 of it actually went to a charity. Here's the evidence, and then on your 1040, you're going to see a line that says IRA distributions, and then there's another box next to it that says taxable. So if you're doing QCDs, those two numbers should be different, meaning the taxable amount that came out of your IRA should be lower than the total amount that came out of your IRA. Now, again, there's some limits. Now, there's $100,000 per person that you can do per year, which obviously is a lofty amount. So, again, keep that in mind. And it has to go to a legitimate 501c3, meaning churches, university, hospitals, 501c3 public charities. Donor advised funds do not count. This is important to note. Because if you're utilizing a donor advised fund, that's kind of on a different island on its own, but you cannot use that QCD to keep that QCD status going into a donor advised fund. So important thing to note there. But again, when it comes to the QCD, it's a great option. If you're charitable minded, you have pre-tax money and you want to use that as your gifting source to those charities and not have that amount of money actually arrive or show up on your taxable income on your tax return, it's a great option.
Yeah. Something else I like to see clients do is use their RMD, especially if, the end of the year, just replenish your emergency cash reserves. Maybe you've dipped into it a little bit throughout the calendar year. This year you had to buy a whole new set of tires for your car or a little bit of extra maintenance around the house. Well, then just replenish your emergency fund. So you've taken it out, you're satisfying the distribution of it, but if you don't need it, at least set it someplace smart that could be of benefit to you in the near-term future.
If you're listening to this and you're like, well, I was very aggressive with Roth conversions. I don't have a traditional IRA, but now I have an inherited IRA from maybe a deceased parent. you can also use qualified charitable distributions out of that inherited IRA, especially if you're subject to the RMD rules per the Secure Act, where maybe you're subject to 10 years, or maybe you're not, and you want to use that as your source. You absolutely can. This is the Real Money Pros. We got to take a break. Stay with us.
Make this year that you work smarter, not harder, with Ataraxis. As your strategic partner, Ataraxis becomes an extension of your business, taking the burden of HR, payroll, benefits, workers' compensation, compliance, and staffing off your plate. You'll have more time to focus on operating and growing your business. Let Ataraxis handle the details so you can focus on what matters most. Learn more at ataraxis.com. That's ATARAXIS.com.
As we age, managing our finances can become increasingly complex with ever-changing tax laws, estate planning, insurance needs, and investment environments. At Apollon Wealth Management, their goal is simple: to help enrich your life with personalized, expert financial advice. With a nationwide network of advisors, they're committed to delivering the best solutions for your financial future. It's time to take control and get the guidance you deserve. Connect with an advisor today by visiting The Real Money Pros. That's therealmoneypros.com.
Looking to make your dream of home ownership a reality? Look no further than Academy Mortgage, your first choice home loan lender. Academy strives to offer the best rates and terms tailored to your financial situation. At Academy Mortgage, you'll be treated like family, not just another file. Navigating today's ever-changing housing market can be challenging, but their team is here to help. Experience the zero-down options, including loans with no mortgage insurance. They also provide specialized medical professional loans and unique 2-to-1 rate buydowns that reduce your monthly payment for the first initial years of your loan. And forget about dealing with brokers and middlemen. With Academy Mortgage, everything happens in-house, from origination to funding. Say goodbye to hassles and surprises. Begin your home ownership journey today by visiting them online at academymortgage.com. That's academymortgage.com.
Academy Mortgage Corporation, NMLS 3113, is an equal housing lender.
Academy Mortgage, your first choice home loan lender.
This open enrollment, start making meaningful progress towards your long-term financial goals. Did you know that a health savings account, or HSA, is the most tax-advantaged account in the U.S.? Contributions are tax deductible, which reduces your total taxable income. Withdrawals for eligible health expenses are also tax-free. And last, capital gains on investments are also tax-free. Did we also mention that it's free for individuals? Visit livelymee.com/pro today. That's livelymee.com/pro.
And now, back to the Real Money Pros.
Welcome back. This is The Real Money Pros. TheRealMoneyPros.com is where you can find us. Use the Ask the Experts feature. Use the chat feature. We are live, so send us a message. You got questions? Send us a message. You want to talk to us live on air? Great. Phone lines are open. 979-59-MONEY. That is 979-59-66-639. I've been told I'm a bit of a fast talker, so I got to make sure I slow down. And I kind of run in that too, like listen to radio programs, and they just run through and speed through that number, and it's like, dang it, I don't remember what that phone number was.
The problem is you just get on autopilot, right? It's like a muscle memory thing, and you're just saying the numbers super fast, and you gotta slow down. You gotta think about the listener.
What's the saying? Is slow is smooth and smooth is fast. All right. Again, therealmoneypros.com. Best way to interact with us. You can see our sponsors. We got great sponsors, one of which is Ataraxis PEO. Listen, if you are a business owner and you want to focus solely on your business, you don't want to be bogged down with the time-consuming administration of HR, such as handling payroll, offering benefits. How do you handle the legalities of hiring or maybe firing someone in the state that you are in? This is where Ataraxis PEO can help. So again, visit therealmoneypros.com to learn more. Jeremiah Bates joined with Nick Daniels. We're talking about effective strategies that you can look at potentially before we are up against the end of the year. What we were talking about last segment is when you are up against required minimum distributions. There are a lot of angles that you can look at actually how to take this, meaning it's not just, hey, this year, as of these past years, I know I got to take a certain dollar amount out. I'm going to take it out. It'll transfer to my checking account, and then I'll figure out what to do with it, either spend it, save it, reinvest it. But there are some more nuances that you could look at executing. So we talked about the qualified charitable distribution. That is certainly a valid strategy where if you want to check the box of your charitable donation and not have those dollars actually hit your tax return as taxable income, great. That's certainly an option. Now, you can also look at this as effective cash flow planning too, meaning if you're in retirement, you're likely, and again, this isn't a problem to have. When you're working and you're doing the delayed gratification, you are in accumulation mode, meaning you're saving, you're investing, you're getting growth. And then when you're in retirement, I mean, generally speaking, that's when you transition into decumulation. You're starting to spend down your assets. So that required minimum distribution is a great way to refill that liquidity short-term bucket. Remember, our approach with investing is very simple. Let time determine how you invest or if you invest your money. And it all comes down to 3 different compartments, 3 better buckets. You have a short-term bucket, an income bucket, and a growth bucket of money. When you are in retirement, the liquidity, I would argue, is paramount. Making sure that you have an access to cash or conservative money markets or CDs that's at arm's length, that is not subject to any market volatility. So if you're effectively using that and you have a proper cash flow plan where you are hitting you're taking your trips, you're covering all your expenses, you're likely going to run in a scenario where that cash bucket is starting to drop down a little bit.
Yeah, so to that point, Jeremiah, I've got some clients that for their required minimum distributions, and so for our listeners, understand this, that it's roughly about 4% of the account value.
Yeah, give or take. Paint with a broad brush. But as far as the amount of money you need to take out of your IRA, when we're talking about a required minimum distribution, take your December 31st, 24 balance, whatever that number is, out of all your IRAs, by the way, right? Combine them all together to get that total balance. Take 4% of that number. That's about roughly what you're going to need to take out of that account.
Correct. And so I've got clients that what they do is they use their RMD. They're trying to leave the money invested all calendar year to let it keep making those tax-deferred gains for them as it's working in the markets. And then in December, they take that RMD, that roughly 4% amount, but then that becomes their travel budget for the following year. So if they're taking their RMD right now in December of 2025, and let's just say that RMD totals, $13,000, $14,000 out of all pre-tax accounts combined, then they're telling themselves, all right, now we have full permission in 2026 to spend $13,000 on travel. And it's not going to disrupt any of the other monthly cash flows. It's not going to take away from any other goals that they're trying to reach. And they have the discretion to say, do we want to take one really big trip? We want to go to Tahiti, and it's going to cost a lot in airfare, and we want to be there for a month or whatever? Or no, are we going to take several little trips all throughout the year? But that RMD amount becomes their travel budget for the following calendar year. And it just makes a lot of sense for them, and it makes planning very, very easy for them.
Another option that you could certainly look at doing, and this is a conversation that's popping up for, again, clients that we work with, is, again, if you are receiving that money, you have to take it, then where's a good landing spot for it? You could effectively use that as maybe a Roth contribution for your kids or grandkids, as long as they have earned income. This question comes up a lot when it comes to, maybe younger kids or younger grandkids of, hey, what's an avenue that I should take that could set them up for the future selves so we could get some compounding growth over the long term? And we look at these accounts that are available to them. We could look at 529 accounts that have obviously a qualified account that is for education. I also have some clients who are like, well, grandkids too young, and we don't know if they're going to go to school, and I don't necessarily want those golden handcuffs for those dollars to be only used on education expenses. Well, there's been some recent updates to 529s where, again, if the landscape's opened as far as what counts as actual education expense, it doesn't necessarily need to go to a legitimate college. It could be for a trade school and items like that.
Hey, I'm using a 529 this calendar year to help my daughter go to nail school.
Yeah.
So like if you want to, you want to go to a beauty school to be an esthetician, do hair, do nails, something like that, that qualifies to use $529.
Well, even on the 529 as well, you could use it for, let's imagine if you have like credentials or like a CPA and you have these ongoing expenses, say for like continuing education or various certifications, you can use $529 for that as well. A big update that should not be slept on is, and I ran into this situation with a client where they were aggressive with funding the 529. Child went to school and they ended up having about $25,000 left over in the 529. They didn't have any other kid to transfer it to, and they're like, we got $25,000 in this 529. Should we just?
I hope I know where you're going.
Yeah,
with
should we
this.
just gift it to them? I'm like, well, as a matter of fact, we now have a provision that allows one to roll dollars from a 529 into a Roth IRA.
Yes.
Now you're still beholden to the Roth IRA rules, meaning the child which you're doing this for, who's the beneficiary of the 529, they actually have to have earned income, and that rollover of the $529 acts as if they made a contribution. So you can't do a rollover, let's say, of $7,000 for this year and then do a contribution on top of that.
Yeah.
Not the case, but meaning a 529 is not a bad route to go. You could just gift it to them directly, too. If you don't want to put it in a 529, you don't want to put it inside of a Roth IRA for them, you can gift a single person up to $19,000 this year without having to file a gift tax return. Remember, a gift to someone it's not taxable to you. It's not taxable to them. The only thing you need to pay attention to is that annual gift exclusion amount. If you go above it, which again is $19,000 per person, you're going to have to file a gift tax return. And basically you're just saying, hey, here's the person I gifted to. Here's how much we gifted them. But again, no taxable consequence in that regard. This is The Real Money Pros. When we come back, let's talk about taxes when it comes to Roth conversions. What should you do? We'll be right back. Apollon Wealth Management has transformed the way our team delivers financial advice. With their support, we're more equipped and more empowered than ever to provide top-tier financial planning, investment management, and personalized financial guidance. Apollon has been a key partner in helping us achieve our clients' unique financial goals. Whether you're an advisor looking to enhance your client experience or an investor ready to take your wealth management to the next level, reach out today to The Real Money Pros by visiting therealmoneypros.com. Let's elevate your financial future today.
I'm Nick Daniels with Tree City Advisors of Apollon. My team and I help our clients implement tax-smart strategies because taxes are one of the largest headwinds your investments face. We use strategies like Roth conversions, 1031 exchanges, and more because a good advisor should help you with more than just investment selection. Visit us today at treecityadvisors.com or call us at 208-888-1244.
Advisory services offered through Apollon Wealth Management, LLC, DBA Tree City Advisors of Apollon, an investment advisor registered with the Securities and Exchange Commission.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and then use tax-free for all of your qualified healthcare expenses. That's why you need Lively, our favorite because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of The Real Money Pros.
Begin your home ownership journey today. Look no further than Academy Mortgage, your first choice home loan lender. And forget about dealing with brokers and middlemen. With Academy Mortgage, everything happens in-house, from origination to funding. Say goodbye to hassles and surprises. Their team of seasoned professionals will be with you every step of the way. That's academymortgage.com. Academy Mortgage, your first choice home loan lender.
Academy Mortgage Corporation, NMLS 3113, is an equal housing lender.
Imagine financial advice without a sales pitch to buy something, and imagine a long-term financial plan focused on your goals, not somebody else's, and the day that you can leave your broker because you know how to do things on your own. At Tree City Advisors, we do things a bit differently than our peers. First, we help you define your purpose for investing. We help you clean up messes or complicated financial issues from your past. We help you organize all your financial pieces into something manageable. We're a fiduciary-only firm, and we design simple strategies. And we teach you how it all works without clutter, confusion, or high cost. We can either do your investments for you, or we can teach you how to do them on your own. In the end, we empower you with knowledge, lower fees, and confidence. Welcome to Tree City Advisors. This is the way we think if financial advisors should work for their clients. At Tree City Advisors, we provide flat fee planning and training. We also offer full service asset management, and we employ do-it-yourself technologies. There's never a fee for an initial meeting or review, so let's get started. Learn more at treecityadvisors.com. Tree City Advisors is an SEC registered investment advisor.
You're listening to The Real Money Pros.
Welcome back. This is The Real Money Pros. Again, visit our website, therealmoneypros.com. It's where you can interact with us. It's where you can access previous podcasts, previous shows, our educational content. We're not here to sell you anything. We are a sponsor-driven program. We want to provide advice. I think the combination of these two roles, it was funny. I went to a kind of a little get-together, right? And I'm kind of a busy guy, so I don't tend to have a lot of time in my schedule to go hang out with, a lot of other people. Let's just put it that way. So, as long as, my daughter, she's getting older. She's starting to form these friendships, and we're starting to interact with the parents. And they're great people. It's great times. But generally, these are limited to school pickup or like whatever birthday party we're going to. It's kind of like a, hey, how you doing? What's new? And then we keep it moving. But last night we went to an actual, like a little get-together at one's house, and it was great. A few people there, a few parents that I knew. And that conversation comes up around, what do you do and all that. And my answer is, well, 80% of my time I am active fiduciary financial advisor, kind of try to explain that the best that I can. And then it's the 20%. The 20% of my time I'm either hosting or co-hosting a radio show. And they kind of look at me. It's like, listen, these two things complement each other really well.
Yes.
Where when we talk about giving advice, like when we're not actually trying to sell anything, Nick, you and I have met with arguably thousands of households, right? Working with them in the fiduciary capacity, so we can take those real life interactions and relay that on the radio, where we're casting a broad net. And I think that a lot of these topics and a lot of these stories, if you will, these client scenarios that we're bringing up likely apply to you. I think it's great. And then on the flip side, doing the radio, hey, we got to make sure that we can effectively take these strategies and explain them in a way that are not complicated, they're digestible, and that also helps us in the realm of working with clients who are sitting across from us from the desk. So if you're going to explain like what's our objective here on the radio show, it is that. And of course, we are sponsor driven. So visit therealmoneypros.com, view our sponsors, one of which is Apollon Wealth Management. Of course, they are partners of our firm, Tree City Advisors of Apollon. So if you are a client looking to get a little bit more sophistication and kind of a holistic look, whether it's how should I start implementing tax strategies? How should I look at investments? How should I look at how my retirement, my cash flow is looking? I'd never really had a full dialed in nuanced retirement plan put together. This is where we have a network of fiduciary advisors across the country by the way, that can help you. Again, visit therealmoneypros.com, and that's where you can get more information on Apollon Wealth Management. Jeremiah Bates, joined with Nick Daniels. Okay, we're talking about end-of-year items, and we're really ringing this chamois on if you have a pre-tax IRA, talking about required minimum distributions, how you should look at that. And one thing that I pointed out is where if you're going to do a QCD, it's great. The idea is great. You're like, wow, this sounds wonderful. But for it to be executed correctly, you have to make sure that it lines up on your tax return. We already covered that. I had 3 meetings over the past, I'd say 3 weeks, where last year, 2024, we were doing non-deductible IRA contributions, and I'll explain that, then converting those dollars into a Roth IRA. So if you're listening, you're like, well, what does that even mean? Okay. The benefit of a Roth IRA is this. You do a contribution into a Roth. You do not get any tax benefit on the money that goes into the Roth, the actual contribution.
Correct. If you make $100,000 and you put $7,000 into a Roth, the IRS looks at your income as still being $100,000.
Correct. So the question is, well, why would I do that? Well, because if you let that money grow, it's all tax deferred, no taxable offense, grows, 10, 15, 20, maybe even 30 years down the line, you want to start pulling that money out to fund your retirement, completely tax-free. You do not pay a cent in federal or state income. The best way I can explain this is that if you have $1 million inside of a traditional pre-tax IRA or 401k for that matter, or a SEP IRA, you don't really have $1 million.
You have a spendable $650,000 spendable.
Yep, because
versus
when you pull the money out, it's going to be taxable. Now versus the Roth IRA, you got $1 million, you truly got $1 million because you pull money out, you're not paying any taxes on it. So that is the benefit of the Roth. Now when we talk about these backdoor Roth contributions, which I think a lot of people have heard of, it's like, wow, why would you do that? Because the IRS says that, hey, you want to do a Roth contribution? Great. But if you make too much money, you are disallowed.
Correct.
Now, keep in mind, this is not regarding Roth 401ks, whether you're self-employed or you're doing contributions to your employer plan. This is completely separate. This is where you're looking at, hey, for this year, if you're under 50 years old, you can do $7,000 into a Roth IRA, or if you're 50 or older, you can do $8,000 into a Roth IRA. But if you make too much money, which by the way, for 2025, if you're married filing jointly, if you're basically modified adjusted gross income, if you're $246,000 or more, you're completely phased out. So for those of you who are earning sizable income and you're like, hey, I want to put money into a Roth, here's how you do it. You establish a traditional IRA and you fund it with hopefully the max contribution. Let's just say it's $7,000. And then you can effectively convert it to a Roth. So you put money into the IRA and you want to convert this thing right away, which I'll explain why in a second. So it's great. You basically did the backdoor Roth execution of where you did a non-deductible IRA contribution, put the money into the Roth, a legitimate way using some tax loopholes to fund your Roth IRA as a high income earner. It's great. But the kicker here again is how it is actually marked on your tax return. Because again, that IRA is going to issue a 1099-R saying that, hey, Mr. Smith, you pulled out $7,000 out of your IRA in tax year 2025, and if you're self-preparing or you're having a CPA or your tax professional prepare, you got to make sure that on your tax return, it's earmarked as a non-deductible contribution, because if it's not, then that's actually going to be earmarked as a taxable distribution. I had a client, I've had 3 clients where we did this and it just, their CPAs missed it. They missed it and they saw the 1099-R showing that between the households, because these 3 households, it was married filing jointly. We did it for both spouses. It showed us an IRA distribution last year, taxable amount, $13,000. There was no Form 8606, which is a key component in this. It's the tax form that tracks those non-deductible IRA contributions. So again, you're putting money into an IRA, but you're not reducing your income on that contribution, which, by the way, if you make that level of income, you probably can't even deduct it anyways.
Well, and on being able to deduct your traditional IRA contribution anyway, it also gets a little bit nuanced as far as like if you or your spouse are covered by an employer-sponsored plan,
it reduces even more.
It reduces even more, yeah.
Yep.
So there's actually a lot of people out there that cannot make a deductible IRA contribution anyway, so you might as well take advantage of the backdoor Roth strategy.
Indeed. So again, love the backdoor Roth IRA conversion. It's a strategy that can help that allows high-income earners who would normally be disallowed to do a direct Roth contribution to use the backdoor Roth to effectively get money inside your Roth IRA. It's great. However, you got to make sure on your tax return it's executed correctly. And the client that I just ran, I saw this yesterday. Like I'm reviewing the return. I'm like, oh no, not again, not again. And it was $13,000 combined, and they have a pretty high effective tax rate. So you just multiply that effective tax rate by that $13,000 that was marked as a taxable distribution. I'm like, here's the amount of money that cost you. So, well, what do you do? I'm like, well, let's reach back out to your CPA and let's say, hey, should we look at amending this? And then obviously we've done the same thing in 2025. We're going to say, hey, make sure on the 2025 return, you're marking this correctly on the tax return. So any of you out there who has done this backdoor Roth contribution over the past few years, make sure that it was marked correctly on your tax return. And moving forward, if you're going to be doing it this year, make sure it's marked accordingly. Now, again, this is not something that needs to be done before the end of the year. You have up until April 15th of 2026 to make your 2025 contribution into a Roth or a traditional IRA or doing this backdoor Roth strategy. So what that effectively allows you to do is work with your accountant, work with your CPA, or if you're self-preparing, you get all that information, you know where all your income is, so you get a clean picture. So then you can say, all right, now I want to do this. And then since you're doing it really in conjunction with when you're filing your return, it's marked correctly on your return.
Yeah, absolutely.
So again, the backdoor Roth strategy, great strategy. Make sure it is executed correctly, because if you think about it, that's double taxation for those clients. They receive that money through wages, meaning they paid Fed income, they paid their state income if they're in a state that actually has income taxes, and if they probably paid payroll taxes on it too. They did the they did the non-deductible IRA contribution, wasn't marked right on the return, then they're getting taxed again.
Yeah.
Extremely inefficient. Do you see how these strategies can easily get slipped up and cost you money? Don't pay more money and then taxes what you need to. That's what we're really trying to say. This is the Real Money Pros. We'll be right back.
Businesses today face a barrage of challenges. They hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. And putting together the right team to run your HR-related tasks can be expensive, let alone time-consuming. Enter Ataraxis PEO, your professional employer organization ready to tackle all your HR needs, from payroll to benefits administration, payroll services, workers' compensation, and talent recruiting. They've got you covered. With Ataraxis, you gain access to a team of experts who handle the nitty-gritty of HR, freeing you up to focus on what you do best, growing your business and growing your revenue. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. So say goodbye to the stress of HR administration and hello to Ataraxis. Experience the power of a true business partner with Ataraxis PEO. Visit ataraxispeo.com. That's ATARAXISPEO.com. Ataraxis, elevating businesses for the benefit of all.
Have you ever met with a financial advisor looking for some advice just to leave being sold an annuity you didn't want? At Tree City Advisors of Apollon, we do things a bit differently. We focus on your financial goals, helping you fix past mistakes, simplify your current finances, and plan for the future with confidence. Your first consultation is always free and without obligation. Visit TreeCityAdvisors.com and start your journey to financial freedom now. That's TreeCityAdvisors.com.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and then use tax-free for all of your qualified healthcare expenses. That's why you need Lively. Our favorite because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of the Real Money Pros.
And we're back to the Real Money Pros.
We're back. This is the Real Money Pros. Again, therealmoneypros.com is where you can find us. We got great sponsors. We truly do. Probably and these sponsors we've actually worked with, we've vetted, like we have real experience with them. So this isn't just something that we're just pulling out of our back pocket. So again, we're a sponsor-driven program. We're here to give advice and support our sponsors. Like I said, they're great sponsors, whether it's Apollon Wealth Management, it is AdderAccess PEO, Guild Mortgage. These are great sponsors, and we can get you connected with them. Again, realmoneypros.com. Use the Ask the Experts feature. We have a new website that we're just waiting for compliance approval to actually go live, which I'm hopeful will be next week. And we're really going to have some great visuals around our better bucket system. You've heard us talk about the buckets, effectively time-based investing, which is coordinated with your goals, your wants, your needs, your wishes, and making sure that you're getting that perfect balance. I would say perfect, but that desired balance between liquidity, between growth, and also making sure that you have a replenishment of the burn rate that you're doing on a monthly and annual basis. And that's where the income portion comes in. So again, it just helps you coordinate all of your assets and you understand exactly how to invest your money based on your desired outcome. So excited about that. Hopefully it should be Monday, Tuesday next week, and you'll be able to learn more. So again, Jeremiah Bates, Nick Daniels, fiduciary financial advisors here at your service. You have a question. We've been talking about RMDs. We've been talking about effective ways to pull money out of your IRA, really end of year strategies. So if you have something that you've been pondering or something that you read online, reach out to us, 979-59-MONEY. That is 979-596-6639. One of the clients I actually met with last night, they said, one of the main reasons that we wanted to reach out on top of this end of year stuff is that we watched this documentary. I forget the name or what service or streaming service it was on. And the documentary was kind of around retirement, and one of the takeaways that they got from that documentary was Social Security. The fact that it's under strain, it's likely not going to be for them there in retirement. They're, late, I would say like late 40s, early 50s.
Okay. Hey, careful there, late 40s. I might resemble that remark.
But again, their concern was, hey, how should we start planning and putting things together to where it just excludes Social Security? Like, if this were to happen, if Social Security is rug pulled, no longer there for us, or it's a significantly reduced amount, how can we prepare for that? I said, great. Here's exactly how we would do it. So again, sentiment on there is, if you have something top of mind or a concern, send it our way. We'll give you some advice, and we'll probably ask you some questions that can hopefully get you on a better path. Again, 979-596-6639. I want to talk about taking distributions out of an IRA and how you should view the tax withholding on this. And this is a question that, again, it seems like we're being redundant of saying, this is a question that gets brought up a lot. Well, we get a lot of questions that get brought up a lot again. And one of these is, and where this is really coming from, is where clients are filing their tax return and they're running into penalties, interest and penalties, because they didn't do enough withholding throughout the year. And this is where we enter in those quarterly estimated tax payments.
Yeah.
You know, when you file your return and then it's generated usually at the top of that whole packet where you have, it's like that little perforated line where you're supposed to cut it and that number amount's filled in there, and one's applicable for quarter one, quarter two, quarter three, quarter four.
Yes.
Essentially, you're paying taxes along the way throughout the year. And generally speaking, that's what the IRS wants. When you are working and earning a wage, you're effectively paying out of your W-2 withholdings those estimated taxes throughout the year. And then when you get into retirement, sometimes you might have federal withholding out of your Social Security or federal withholding out of your pension, or maybe you're doing some federal withholding out of your IRA distributions. So how this all works together is understanding that if you are not withholding the proper amount or making payments along the way, then yeah, you could likely run into a scenario where the IRS, when you file up your return, said, hey, you did not pay us enough. You did not do any estimated tax payments. You didn't give us any money along the way. So here's quarter one, quarter two, quarter three, quarter four. Each one has its own penalty and its own interest earning period.
Correct.
To where, and again, the scenarios that I've seen this on, they've been negligible, right? But again, I think it's just the what's the term? It's the I'm losing the word, but it's the principle. It's the principle of the matter of, I don't want to pay any penalties or interest to the IRS. But in the reality is, it was just so small, and you probably earned more money on your cash and your high yield savings that even though you got penalized, the net result is that it wasn't a big deal.
Yeah, but also let's be honest. I mean, this is happening to our clients mainly that are retired, so they're not having things automatically taken out of a paycheck any longer. So they're not thinking about this. I mean, all of your working years, basically, like, things are on autopilot. You know, you go in, you swipe your card, you go into the building, you do your job, you leave. The payroll department sends you, they send all the information in, they send you a check, and you're just living your life. You're not really paying attention to what's coming out at necessarily every single paycheck, every 2 weeks or whatever like that. And so just by habit, you're moving into retirement and you're thinking, this isn't, I'm paying attention to, like, what days am I playing pickleball this week? I'm paying attention to what school assembly am I going to, which grandchild has what this week that I'm going to go and attend. You're not thinking about, oh yeah, I also have to be responsible for making sure that taxes are paid systematically throughout the calendar year now that I'm retired.
Yeah, I mean, listen, there's safe harbor rules that the IRS produces to where if you pay enough throughout the year, then you won't run into any interest or penalties. But let's imagine this scenario where you're listening to this and you're like, I took a large amount of money out of my IRA and I didn't withhold any taxes. And now your mind's starting to turn of like, I don't want to run into a penalty, and I don't want to run into any of this. And I had a client that actually ran into this earlier the year. It was a new client that we onboarded, did a large distribution out of the IRA, no tax withholding, no other sources of income that they had any federal withholding. I was like, listen, the penalty is probably going to be this. Like, we got a rough calculation of it. It wasn't a significant amount, but again, they're like, well, how can I avoid this? Important to note, again, we're talking about pre-tax IRAs or maybe an inherited IRA, is that when you have a W-2 or a distribution out of an IRA, when you do withholding out of that, you're not subject to the Q1, Q2, Q3, Q4 estimated payment periods, meaning the IRS looks at withholding out of a W-2 or withholding out of an IRA distribution as kind of equally received throughout the year. So if you're running into a scenario where you feel very confident or you 100% know that you did not withhold enough money throughout the year, and you've already missed the window for Q1, Q2, and Q3, you still have time for Q4, you can use a distribution out of that inherited IRA or a distribution out of your IRA. You can elect higher federal withholding out of that distribution to make sure that you've covered the amount of taxes you should have been paying throughout the year. So again, that is an effective strategy within your IRA to avoid penalties or lack of withholding, and you still have time to do it. Meaning, I have a client where household, each the husband and the wife each have an inherited IRA, and they're subject to required minimum distributions.
Gotcha.
Not a high amount, but again, they ran into that scenario where last year they were like, gee, we got hit with a penalty. We didn't pay enough. They kind of transitioned to a more consulting role. So they kind of went self-employed. So there wasn't that withholding. They said, listen, we want to make sure we do not run into it this year. I said, great. Let's take these required minimum distributions that you have to take anyways, and let's just send it all to the Fed.
So you did 100%.
Couldn't do 100% for whatever reason. We did 99.99%. So when you look at that gross distribution, let's say it was, I don't know, $10,000. $999 actually you see as a line item on the statement that paid to the Fed.
Yeah.
And then that remaining amount, it just went into their individual account. So pay attention to that. And you still have time. If you really don't want to pay more in taxes than what you need to, you don't want to run into penalties for lack of withholding, pay attention to the IRS safe harbor rules, meaning if you paid 100% of last year's total tax, you're okay. And you can do that through an estimated payment or IRA withholding. Or if your AGI was over $150,000, you can do 110% of the AGI as basically estimated tax payments in conjunction with your IRA withholding. So don't feel that you just need to take it in the gut as far as paying that penalty and interest. You can take that approach of higher withholding out of the IRA. Again, this is the Real Money Pros. We're in an extended break, hour one of a 2-hour program. Second hour is right around the corner. Stay with us.
The Real Money Pros is hosted by Brian Wiley and other team members of Tree City Advisors of Apollon. Tree City Advisors of Apollon is a DBA of Apollon Wealth Management, an SEC-registered investment advisor and affiliate of the Real Money Pros. The Real Money Pros and Tree City of Apollon are not affiliated with any of the companies or non-advisor professionals participating on this program. Ataraxis PEO and Apollon Wealth Management are financial sponsors of the Real Money Pros. Additionally, Apollon receives advisory fees for these sponsors and or their representatives for investment advice. Log into therealmoneypros.com to contact the host for advice, show archives, educational material, and more. This program is brought to you by the quality sponsors heard within this broadcast.
Businesses today face a barrage of challenges. They hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. Ataraxis partners with businesses of all sizes and industries. Their mission? To reduce the stress and risk that comes with business owners trying to do it themselves. Visit ataraxispeo.com. Ataraxis, elevating businesses for the benefit of all.
Your emotions can drive many decisions, but when it comes to money, they shouldn't be in the driver's seat. I'm Alex at Tree City Advisors of Apollon. We get to know you and your goals to build a holistic, time-based investment strategy. Investing isn't rocket science, but having the right partner helps you stay the course. Learn more about us at treecityadvisors.com or call us at 208-888-1244.
Advisory services offered through Apollon Wealth Management, LLC, DBA Tree City Advisors of Apollon, an investment advisor registered with the Securities and Exchange Commission.
Are you a do-it-yourself investor looking for ideas from a pro, but not necessarily interested in hiring a pro? Well, I have something to share with you. I build investment allocations for my clients on a daily basis, but sometimes people simply ask if I will share my ideas with them. My answer? Sure. The way I see it, I'm lucky these people consider me to be an expert. So I started writing a quarterly newsletter with model portfolios built for different purposes. My readers get to decide if they want to follow any or some of my ideas. Now, powered by freedomfolios.com and the use of their TD Ameritrade account, my followers can get their investment portfolio in line with my suggestions with the simple push of a button. Using the freedomfolios.com technology is simple and it's fast. I update my models once a quarter, and freedomfolios.com then sends my subscribers a message via email or text letting them know that they may want to update their investment accounts. It's the least expensive way to get professional models without the cost of a pro. Visit freedomfolios.com. See my models there. You can start your free 30-day trial right now. It's freedomfolios.com.
Jen's manicure spot needs an extra pair of hands.
Who's at the front desk right now?
Someone who's handy with everything from nail files to spreadsheet files.
Deirdre's not coming in today? But we have that whole bachelorette party.
Indeed can help her hire great people fast.
I need Indeed.
Indeed you do. Instant Match instantly connects you with quality candidates whose resumes on Indeed match your sponsored job description. Visit Indeed.com/credit and get $75 towards your first sponsored job. Terms and conditions apply.
To offer valuable advice and earn clients' trust as an advisor, it's essential to always put their interests ahead of personal gain or the preferences of any particular company. Advisor Insurance Solutions is dedicated to delivering insurance solutions from an advisory perspective. They provide objective and unbiased insurance planning, making it an integral part of their comprehensive advisory process. If you're looking for insurance guidance that aligns with your financial goals, visit therealmoneypros.com. That's therealmoneypros.com.
Are you in the market to buy a house or just looking to refinance your current mortgage? For helping individuals and families achieve affordable homeownership, Academy Mortgage is a first choice. And when finding that perfect loan for the perfect home, you need a company that will treat you like family, not just another file. To help you navigate through today's ever-changing housing market, Academy Mortgage has zero down options available to you. That includes zero down with no mortgage insurance. We also offer medical professional loans and 2-1 rate buy-downs that help lower your monthly payment for the first several years of your loan. Origination, processing, underwriting, and closing and funding will all happen in-house. With over 34 years in the business, we know that buying a home is more than just a house. That's why it's important we protect our customers and safeguard their financial wellness for years to come. Visit us online at academymortgage.com today to start your journey to homeownership with Academy Mortgage. That's academymortgage.com. Academy Mortgage, your first choice home loan lender.
Academy Mortgage Corporation, NMLS 3113, is an equal housing lender.
Nobody protects you from mayhem like Allstate. I'm a speed bump. Did you hear what I said? I'm a speed bump. And if you have cut-rate car insurance, the cost to reattach your muffler could really be a bump in the road. So switch to Allstate, save money, and be better protected from mayhem, like me.
Based on coverage and limits selected, subject to terms, conditions, and availability. In most states, prices vary based on how you buy. Allstate Bar and Casualty Insurance Company and affiliates, Northbrook, Illinois.
Running out of gift ideas for your loved one? Send flowers with Flower Fix. And need to create joy in your living or workspace? With many working from home these days, create joy in your space with flowers. Flower Fix is a subscription-based flower delivery service perfect for birthdays, anniversaries, or any special occasion. We offer 2 subscription options to choose from, a text-based subscription or a traditional one. Enjoy these big, beautiful hand-designed bouquets that are delivered straight from our flower fields to your door. Log on now, www.flowerfix.com, to choose your flowers today. Have control over when you want flowers delivered. Weekly, bi-weekly, monthly? Get your flower fix at flowerfix.com. Use code FlowerFixPro to receive 20% off your first order. flowerfix.com.
Hi, I'm Stephanie Gallegos with Price for Life. Do you have a life insurance policy that you'd like to sell? If you don't need the coverage anymore or would rather not keep making the premium payments, visit our website, priceforlife.com. Don't let your policy lapse when you can potentially get a cash payment for it. There are several reasons why a life settlement might be a great value to you. Perhaps your policy is too expensive, or you feel you no longer need the death benefit, or you may think you need to wait until death before your family can get the money from the insurance company. This is why you may want to consider a life settlement. Price for Life has excellent resources available along with a free evaluation process to help you understand the value of your policy and the options available to you. Price for Life's clients have received hundreds of thousands of dollars for their policy when they would have otherwise just let it lapse by stopping the premium payments. Get the compensation you deserve. Visit priceforlife.com today and fill out the case evaluation form to see if your policy qualifies. That's life.com. priceforlife.com.
Healthcare expenses can be a burden, so why not make the most out of the money that we'd spend anyway? Take advantage of the most powerful tax advantage account title available to us, a health savings account, also known as an HSA. That's why you need Lively. Visit Lively right away. Open your HSA, roll other HSA money into that new plan, and then start saving. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO.
Money Pros is brought to you by The Real Money Pros and the sponsors heard within this broadcast. Material presented on this program may not be suitable for you. Consult a registered investment advisor when evaluating any particular investment, security, or investment strategy. The views, opinions, or advice offered by the hosts and guests do not necessarily reflect those of this station. Brian Wiley and Jeremiah Bates are investment advisor representatives with Apollon Wealth Management, an SEC registered investment advisor. The Real Money Pros with Brian Wiley and Jeremiah Bates, the weekend's smartest money show. Investing, taxes, legal topics, insurance, and every other confusing money topic made simple.
Welcome back to the Real Money Pros, hour 2 of our 2-hour live program. Live meaning you can interact with us. One of the best ways to do that, over the phone. Because if you have a question, it's likely that all the other listeners probably have that same question too, top of mind. 979-59-MONEY. That is 979-596-6639. You can visit therealmoneypros.com. Use the Ask the Experts feature. You will get a response by one of the fiduciary advisors on our team. Or use the chat feature. If you send us a chat question, I will answer it on air. It'll go directly to us. I have that chat box open right in front of me. And again, therealmoneypros.com is where you can get access to our previous educational content. It's where you can get access to our great sponsors. Remember, we are a sponsor-driven program. We are not trying to sell you anything. We're just trying to give you good advice. I'm Jeremiah Bates, joined with Nick Daniels. We are fiduciary advisors. We talked about in the first hour, end-of-year strategies, how to effectively look at doing distributions out of your IRA, Roth conversions, backdoor Roth IRA contributions. The list goes on. But let's pivot. Let's change gears. I want to talk about Trump accounts, and there was some news that hit the headlines over the week about the Dell family committing, what was it, $6.5 billion?
$6.25 billion.
$6.25 billion. My question to the listeners out there is this. Politics aside, again, we're not talking about are you in favor or are you not in favor of Trump, but are you in favor of these Trump accounts? Meaning, are you going to take advantage of essentially the free money that's being offered to, if you're eligible, depending on the date that your child was born, are you going to take advantage of it? And if not, even regardless, if you're not eligible for that initial seed funding amount that would come for the government, do you like this idea? Do you like the idea of having an account that is earmarked for your child that you can put money into? There's no tax benefits on those monies you put in, but it's a growth vehicle inside of this account that is for their future selves. Are you a fan? Are you not? Or are you politically swayed to the standpoint, well, the fact that it's called Trump account.
I was about to say, if it was called anything other than a Trump account, would you be a fan?
Yeah, so maybe the marketing on that could have been a little bit, no, I'm just kidding. But again, are you a fan of this? Are you not? Or does your political side of which you lean, do you prefer not to use this mechanism? But let's get into the details because, again, there are some aspects of this that you need to pay attention to on the rules around this, when there's constructive receipt, how much you can put money into it, and really where we are right now in this process.
Yeah, so let me give you some high-level details. So these accounts, basically starting January 1 of 2026, actually the funding, from what I've seen so far, you can't fund them until at least January 4th of 2026, but you can start to put money into these Trump accounts at whichever custodian you're using to open them. Who is eligible for these Trump accounts? It's got to be the beneficiary of a U.S. citizen, right? And they've got to be under the age of 18, whose parents or custodians are tax filers, and this minor under the age of 18, they have to have a valid Social Security number. Now, where this, like, the government funding these comes in is for children born between January 1st of 2025 and December 31st of 2028, the federal government is going to give a $1,000 seed contribution to that account. So let's be clear. If you have a child who is not going to turn 18 in calendar year 2026, we tracking?
Yep.
Okay. If they're not turning 18 in 2026, you can open a Trump account for them. If they're 15 years old, if they're 9 years old, if they're 5 years old, you can open a Trump account for your child in 2026. If they're going to be turning 18 next year, now it's too late, okay? The seed money only applies to children born between January 1st of 2025 and December 31st of 2028. And there is an automatic enrollment, actually. So if no one establishes the account for an eligible child, the Department of the Treasury is going to automatically open up these accounts. Not necessarily automatically fund them, but will automatically open up the account for the eligible child. Now, let's talk about contribution limits. I don't know why they couldn't make it simple and put like the same sort of contribution limits as like an individual retirement account, but we get what we get. So on an annual basis, there is a limit of $5,000 per year going into the account. The funds can come from the parents. The funds can come from relatives. The funds can come from employers.
Yep.
Employers can put up to $2,500 per year into these accounts, and those contributions will be excluded from the employee's taxable income. All right? But all of these different sources combined cannot exceed the total of $5,000. Now, what can you invest in these funds? Can you buy Tesla? Can you buy Bitcoin? Can you, if we have a hot IPO that walks across the stage in 2026, can you get in on that? No, you cannot. You are limited to low-cost U.S. index funds. So you can take a mutual fund route. You can take an exchange-traded fund route. Personally, I favor exchange-traded funds over mutual funds. But it's got to be, broad-based U.S. index funds. So think of like an S&P 500 or a NASDAQ index fund. You could do like a Russell 2000 if you want mid-cap or whatever. But like index funds is what you can do. And you get tax-deferred earnings on these things. And eventually what happens is that once this minor becomes 18, the account essentially just converts into an IRA under the
subject to the IRA rules.
Yeah,
right?
subject to IRA rules.
So meaning if you can't touch the money, penalty free up until you hit 59.5, any distributions done out of that account would be taxable as ordinary income to that then minor who now is an adult who now is the owner of the account.
Right. But there are a few caveats, just like with a regular IRA or a Roth IRA. There's a few withdrawals out of these Trump accounts that would get special tax breaks. So higher education expenses, post-secondary credentials, first home purchase. If you're wanting to start a small business, maybe your child's real entrepreneurial, wants to go out and start a landscaping business or something like that. Typically, you can get some more favorable tax treatment on those sorts of qualified withdrawals from these Trump accounts.
What's your take on this? You like them or you don't like them?
I like them. I like them just from the standpoint of, I think in general, we need to be more focused on investing for long term. Just in general, as Americans, we need to get to a point where we're more disciplined about preparing for our own future. You made a comment in the first hour, Jeremiah, that you talked about working with some clients, and they said, hey, can you help us plan as if Social Security will not be there? And I think there's something to be said for us as on the individual side of things saying, no, it's my responsibility to take care of me. It's my responsibility to take care of my kids and provide for ourselves. So I like the opportunity of having an additional bucket that you can put money in and get some preferred tax treatment on it. I mean, obviously you could always open up, before these Trump accounts, you can open up a uniform transfer to minors account or a uniform gift to minors account. You could, if you like small business owners who put their kids to work in the business, and they could do minor Roth IRAs and help their kids make contributions to that. Or, if your kids, my son Owen, when he was like 12 years old, he just went around the neighborhood at the beginning of the summer and he scrounged up about 4 or 5 yards that he would cut their grass every single week because he was trying to save up for a mountain bike. But if his intent instead was to he was interested in starting to invest, at 12 years old, he had earned income. He was working for that money. I could have opened up a minor Roth IRA for him and he could have started investing. So I just like having an additional tool for families to be invest in. And I don't mind the tax-deferred growth on these things.
Yeah, I think my take on this is free money. I mean, if you qualify for that seed money, which I was 4 months behind that date, that would give the little Turner boys, we like to call them, an extra $1,000 for what he would see is needed down the line. But yeah, I think if you fall under that criteria where you get that initial seed money of $1,000, makes a lot of sense, right? I think where we're at right now is the logistics of this, of like being able to actually open the account, establish it. Go to trumpaccounts.gov. So right now you can put in your email. It looks like they're going to do another update on December 17th. And then obviously we need some more direction of what financial institutions will then adopt this and be able to allow for that account opening logistics, whether it's like a Schwab, a Fidelity, or even at your bank. But again, what are the options if you want to set up a growth account for your child? We'll talk about this more when we come back.
Businesses today face a barrage of challenges. They hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. And putting together the right team to run your HR-related tasks can be expensive, let alone time-consuming. Enter Ataraxis PEO, your professional employer organization ready to tackle all your HR needs from payroll to benefits administration, payroll services, workers' compensation, and talent recruiting. They've got you covered. With Ataraxis, you gain access to a team of experts who handle the nitty-gritty of HR, freeing you up to focus on what you do best, growing your business and growing your revenue. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. So say goodbye to the stress of HR administration and hello to Ataraxis. Experience the power of a true business partner with Ataraxis PEO. Visit ataraxispeo.com. That's ATARAXISPEO.com. Ataraxis, elevating businesses for the benefit of all.
Looking to make your dream of home ownership a reality? Look no further than Academy Mortgage, your first choice home loan lender. Academy strives to offer the best rates and terms tailored to your financial situation. At Academy Mortgage, you'll be treated like family, not just another file. Navigating today's ever-changing housing market can be challenging, but their team is here to help. Experience the zero-down options, including loans with no mortgage insurance. They also provide specialized medical professional loans and unique 2-to-1 rate buydowns that reduce your monthly payment for the first initial years of your loan. And forget about dealing with brokers and middlemen. With Academy Mortgage, everything happens in-house, from origination to funding. Say goodbye to hassles and surprises. Begin your home ownership journey today by visiting them online at academymortgage.com. That's academymortgage.com.
Academy Mortgage Corporation, NMLS 3113, is an equal housing lender.
Academy Mortgage, your first choice home loan lender.
I know you've been waiting a little bit longer than normal.
Jen's manicure spot needs an extra pair of hands.
Who's at the front desk right now?
Someone who's handy with everything from nail files to spreadsheet files.
Deidre's not coming in today, but we have that whole bachelorette party.
Indeed can help her hire great people fast.
I need Indeed.
Indeed you do. Instant Match instantly connects you with quality candidates whose resumes on Indeed match your sponsored job description. Visit Indeed.com/credit and get $75 towards your first sponsored job. Terms and conditions apply.
And now, back to the Real Money Pros.
We're back. Jeremiah Bates, Nick Daniels, Fiduciary Financial Advisors, here for you every weekend, 2 hours, live program. Call us, 979-59-MONEY, 979-596-6639. The question we're putting out there is Trump accounts. News headlines hit this past week that Trump accounts are getting a sizable cash injection from the Dell family to the tune of $6.25 billion, and that's with a B, if I'm not mistaken. And do you want to take advantage of it? Are you a fan of the idea, or are you not? Or are you saying, forget this, the fact that it's affiliated with Trump and this administration, I'm wiping my hands clean. I don't even want to think about it, not going to touch it. We talked in this last segment, Nick, you covered the details of the Trump accounts of what we know is right now. The reality is this was an idea. Now it's actually being we're getting formal guidelines by the IRS, and this thing's going to move forward in a couple months, meaning in a couple weeks, couple months, we're going to get more direction on it. We're going to actually know where you can set up the account, where you can open it, actually how to fund it. So the question right now in my mind is, okay, if you're a parent and you have a young kid, like I got my daughter Tori, she's 7, Turner, he's turned 1, kid's walking now, he's like nonstop, keeping me on my toes, losing sleep, all that good stuff. But you're a parent and you're starting to think ahead of, what can I start doing now? What can I start doing now to set my child up in a good spot financially? I understand the benefit of compounding growth. I understand the benefit of a long-term diversified investment approach. It's what's secured my retirement. And I want to springboard my child, because I understand that if you can invest dollars that are for them specifically, especially if they're a young age, 10, 20, and then if we're looking at retirement, 30, 40, 50, maybe in 60 years, it's undeniable that benefit.
Absolutely. But understand this. Trump accounts walk and talk as far as, like, they're for a minor, right? They're to benefit your minor child. But what happens when they turn 18? They walk and talk very similarly to a uniform gifts to minors account or a uniform transfer to minors account, meaning you have been, let's just say, like, you have a child that's born this year, so they're eligible. They get the $1,000, and your employer's putting money in it, and you're putting money in it, and they've been getting $5,000 a year. Actually, I'm going to pull up a compound interest calculator. Let's make this legit.
Pull that up, because I want to talk about a story of someone that I knew. And so again, talking about the details of these types of accounts, whether you're talking about a minor Roth IRA, you're talking about a uniform transfer to minor account, or uniform UGMA, uniform gift to minor account, or the Trump account for that matter. Age 18 is when they take control over that account. So I knew somebody who had multiple kids. They were very aggressive with funding these uniform transfer to minor accounts. They had good growth. The oldest child turned 18. I mean, and here's what happens, especially when you have it at least from what I know, because we custody with Schwab. That's where we effectively manage and hold our client accounts. When that child hits what's called age of majority, and that can be different from certain states, but generally speaking, 18, that account automatically becomes theirs. I mean, it's not like they're waiting on you to make a decision. It's like, no, it's no longer in your purview.
Right.
That custodian has your child's name, address, date of birth, essentially all the information that they would need to set up that account on their own. And that's what happens. Like, you'll get notice of that, but then you no longer have control. You're not tied to the account in any way, shape, or form. It is now to your child. So in this instance, that child, when they turned 18, found out that they had a sizable balance. And let's just say that their decision-making around that money was not in alignment with what the parents had in mind when they were funding this account. And there was a big surprise. So again, when you look at minor Roth, UTMA, UGMA accounts, or even these Trump accounts, when that age is hit of 18, you're out of the equation. So something certainly to keep in mind.
So, okay, we'll put some real numbers to this, Jeremiah. So your child, you get that first $5,000 in the year one. You stick it in an S&P 500 index fund. Let's say it averages a 12% rate of return.
Maybe some would say that's a little aggressive, but okay. I mean, for illustration purposes, 12%.
Illustration purposes only.
Previous performances, no guarantee of future returns. Just got to put that little asterisk there, but continue.
All right. For 18 years, you put in an additional $5,000 a year. Okay? So your total contributions, money in, $95,000. Now, first of all, if you didn't even have it invested in an S&P 500 fund, if it stayed in cash, how many 18-year-olds really have their heads screwed on well enough to know what to do with $95,000 when they turn 18? If it was averaging a 12% rate of return during those 18 years, we're looking at over $317,000. That is a dangerous amount of money for an 18 or 19-year-old. So in light of a Trump account compared to the UTMA or the UGMA, at least the Trump account has that additional layer where it becomes essentially it's viewed as an IRA. So if the child at 19 or 20 were to take money out of that, just like, I'm going to get myself a really nice set of wheels. That's exactly what my middle child, and why is it always the middle child? But that's what my middle child would definitely do. He's going to be paying, federal income tax, state income tax, if applicable, an additional 10% early withdrawal penalty on that money. So, it could actually cost him a lot of dough to get that new car. So I like that added layer on the Trump account versus like an UTMA or an UGMA, where you're going to be just looking at long-term or short-term capital gains.
Yeah.
But that's a significant amount of money that we're potentially looking at.
It is. And Nick, you and I were talking about this during the break, that we've worked with a lot of clients where they want this desired outcome to where they're setting money aside for a specific purpose, which is for the future benefit of their kids. And they kind of want to separate it out so it's on its own. Makes sense. I totally agree with the idea. But we also got to understand that devil's in the details. If you put it into certain types of account titles, like the Trump account, that when they turn 18, you are out of the picture. Are you okay with that, or are you not? And that's where I would argue, like, this question got brought up by a young household that I met with. Kids are a little bit older than mine, but my daughter Tori, she's first grade. She's starting to get a kind of a better idea, like just a better awareness of just how the world works. I mean, obviously, 7 years old, first grade. I mean, to that extent. But they're asking, well, like, what are you doing? I'm like, yeah, no, I'm certainly setting money aside. I have a little bit of money going into 529, not much. I have a set-aside account that is not a UTMA. It's just an account that's earmarked for Tori that I'm effectively putting money into, investing for her future self. But one thing I started doing, I'm putting her in front of the computer. I could probably do it on a phone. That actually might be more effective. But I'm having her actually go into the account. She doesn't understand really what she's doing. But I'm showing her, click here. We're going to buy this. Type it in. And I'll kind of explain a little bit. It's probably that's going all over her head. But it's effectively building the habit. So again, look at the desired outcome. Do you want your child to be financially responsible and understand the benefit of compounding money? In my opinion, I don't think just setting up these accounts on their own and say, here you go when they turn 18 is going to get that result. But using these different types of vehicles, the Trump account, get some seed money, get that tax deferred growth. And if they understand the purpose and the benefit of it, then you likely don't run into a scenario where $300,000 plus just goes out the window. This is Real Money Pros. Stay with us.
As we age, managing our finances can become increasingly complex with ever-changing tax laws, estate planning, insurance needs, and investment environments. At Apollon Wealth Management, their goal is simple: to help enrich your life with personalized, expert financial advice. With a nationwide network of advisors, they're committed to delivering the best solutions for your financial future. It's time to take control and get the guidance you deserve. Connect with an advisor today by visiting The Real Money Pros. That's therealmoneypros.com.
Did you have a tax strategy going into this year to help maximize your tax savings? I'm Jeremiah Bates with Tree City Advisors of Apollon. We consider key factors like required minimum distributions, Social Security, net unrealized appreciation, 1031 exchanges, and more. Because a good advisor should help you with more than just investment selection. Visit us today at treecityadvisors.com or call us at 208-888-1244.
Advisory services offered through Apollon Wealth Management, LLC, DBA Tree City Advisors of Apollon, an investment advisor registered with the Securities and Exchange Commission.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and and then use tax-free for all of your qualified healthcare expenses. That's why you need Lively. Our favorite because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of the Real Money Pros.
If you have a small business, Staples has your sign.
Banners for my bakery?
Staples has your sign.
Oh, posters for my new pet store.
Floor decals for a pharmacy.
Every day, Staples associates help every kind of small business create bold signs to make big impressions. And now get $10 off custom signs, banners, and posters when you spend $50 or more. This is your sign, so print it big at Staples. Ends 5/28. Visit staplesconnect.com/thisisyoursign for details.
Imagine financial advice without a sales pitch to buy something, and imagine a long-term financial plan focused on your goals, not somebody else's, and the day that you can leave your broker because you know how to do things on your own. At Tree City Advisors, we do things a bit differently than our peers. First, we help you define your purpose for investing. We help you clean up messes or complicated financial issues from your past. We help you organize all your financial pieces into something manageable. We're a fiduciary-only firm, and we design simple strategies. And we teach you how it all works without clutter, confusion, or high cost. We can either do your investments for you or we can teach you how to do them on your own. In the end, we empower you with knowledge, lower fees, and confidence. Welcome to Tree City Advisors. This is the way we think if financial advisors should work for their clients. At Tree City Advisors, we provide flat fee planning and training. We also offer full service asset management, and we employ do-it-yourself technologies. There's never a fee for an initial meeting or review, so let's get started. Learn more at treecityadvisors.com. Tree City Advisors is an SEC registered investment advisor.
You're listening to the Real Money Pros.
This is the Real Money Pros. Again, phone lines are open, 979-59-MONEY, 979-596-6639. Do you like the idea of the Trump accounts? Do you not like the idea of the Trump accounts? Do you like taking an alternative route as far as future savings for your child where you can invest the money and get some compounded growth out of it? What do you think? Do you think that this spurs, you hear these headlines a lot where we're in a retirement crisis. There's not enough money to sustain people's lifestyles when they actually, in fact, decide to cut the corporate cord. So you want to set something up for your kids that helps them hit these milestones in life. Maybe it's college. Maybe it's buying a first home. Maybe it's a wedding. Maybe it's seed money for starting a new business. Whatever the case is, I think a lot of parents identify this of like, yeah, that's a big point. Like, and there's these seasons of life where I really try to take in when I meet with clients who have their kids that are, they're graduating high school or graduating college, and I'm trying to take these little bits from that and put them in the back of my head because obviously my kids are so far away from that, but just trying to plant these seeds and seeing where are these successful marks happening and what are these people doing that are setting their kids up, right? I digress. I think this really comes down to this idea of, we talked about these various accounts that are specifically earmarked for kids, like for their benefit that you can set up as a parent. And we talked about the pros, the cons, the pitfalls, the risks that are associated with that. And Nick, you and I were talking about during the break is to avoid that is having a plan. Like when you start this, understand like what is your plan behind this? And then once that plan is effectively understood, then you could look at option A, option B, option C, option D, and understanding each option. And then when you pick that option, or maybe it's a combination of those options,
yes,
that there's not a surprise, if in the example your kid turns 18 and they just take the money and run with it.
Yeah, so I think like that's one of the things that I'll get into these conversations, I'll say like with my gym bros, right? I'm usually at the gym. the same time on the same days every week. So I got this little community there, and we'll always pick each other's brains based on like the industry that they work in. It makes life fun. It makes the workout a little more fun. But you know, my gym bros will ask me like investing for their kids or whatever, and I like to get into like, okay, but what's your intent? Like, what are you actually trying to accomplish? And usually when they start asking me questions regarding finances, it starts off like this. I was watching TikTok and this guy said I should do this with my money. And I just like shake my head and start laughing. And I'm like, okay, if you fit those parameters, sure. I don't disagree with that advice that you just got from that finfluencer. But does that advice from that finfluencer, does that actually fit you as a person? Do they know you? Do they know what makes you tick? Do they know like how serious you are about these other things you've talked about in conversations? And the answer to that question simply is like, no, the person on TikTok does not know you. And so when I'm in these conversations where people are wanting to do something, especially like on this topic of doing something that will benefit their kids, give them a leg up, oftentimes what I discover is that the real intent is the parent is wanting to create what I'll call an opportunity fund. And they don't have a specific purpose for the money other than when an opportunity presents itself, I want to be able to strike while the iron's hot. That could be helping with college expenses. That could be helping with the first-time purchase of a home. That could be, for parents of daughters, a.k.a. me and you, that could be a wedding in the future, Indeed. Right? It could be a replacement vehicle, whatever. If they want to maintain control of the account till the day they die, then that eliminates these UTMA and UGMAs. It eliminates a Trump account because they want to maintain control of that and never just turn over $200,000 directly to an 18 or 19 or 20-year-old kid. So it's like, okay, once you figure out the intent, that helps you steer the individual to what type of account they really need to begin doing this investing for the long term.
Yeah, and I would say too, I mean, if you have an advisor that you work with, a good trusted advisor, hopefully fiduciary, bring your kids into those meetings. I mean, maybe, Tori's age 7, maybe a little bit too young, but they start getting into those mid-teenage years, high school, bring them in and have them meet with the advisor. I've done that a handful of times. It's great. It is the best. I love it. You're giving the kids good education, like helping them understand some nuance to finances and investing that they likely won't get through the traditional education system. Do that. I think that's a great idea. Or if it's not with the advisor, do it yourself. Meaning if you're seeing successful outcomes with how you're managing your money, make sure that you're making it a point for them to understand that as well. Because, I mean, if you think about one of the biggest things in life when you're talking about emotion and quality of life impact, it is money. So you can't lose sight of that. And I agree, and it's when you're mentioning, I saw this on TikTok. I think we need to start having a segment once every week of
I saw this on TikTok.
Or like debunking the financial influencers' advice that's out there, because there's just so much bad stuff out there. It's just so bad. But it really comes down to like what is the plan, and having someone that can help guide you through that, have a good Q&A session to truly understand, and then help you understand those vehicles or those options. And then once you have that understanding, that education, the dynamics of how they work and how it coordinates with the overall plan, then you can arrive at the best option to take. Maybe it is a 529. Maybe it is a Trump account. Maybe it is a minor Roth. Maybe it is maybe it is a UTMA account, or maybe it's none of those. Maybe it's an account that's under your name that you are funding, that you have set aside for them, but you're in control of when it actually transitions over to them. Now, I will say this. I'll put a caveat to this. Like if someone's listening, it's like, well, you can do a certain type of trust planning that could satisfy all this. Yes, you can. I mean, really, there's so much nuance and strategies that you can do through irrevocable trust planning that you can circumnavigate a lot of this. Yes, you can. But if we're excluding that from the equation, because obviously there's a big cost to do that, a lot of maintenance, and obviously it depends on the sophistication level that you want to get into.
Sure.
But if you're just truly looking at this of, I want to set up a benefit for my child, I want to understand the risks of them potentially spending the money on something really dumb, then yeah, I think potentially just setting up a non-qualified brokerage account that's earmarked for your child. You can put them as the beneficiary on that account.
Transferable on death.
So if something were to happen to you, you know that it's automatically earmarked for them. At the end of the day, you are managing the investments. And then most importantly, what I would say is them seeing it, them getting the education, understanding that, hey, this money is for me. It is growing. It is invested. Here's how this investment strategy works. And I know I don't get it. Like maybe I have to hit some certain levels of criteria, some checks and boxes that maybe you establish that they understand before they take control over that money.
Yeah. Now on that note, last segment, Jeremiah, when you talked about like you have Tori in your lap and you're having her, now click here, now buy this, now type this, all that. The first place my mind went was, number one, I'll bet she's going to, as she ages, she's going to look back and just remember like, oh, I just remember like that time with my dad sitting on his lap. Like she's not understanding the dollars right now. She's understanding like the connection, the time spent. But what's eventually going to happen is as she understands those numbers, she's going to start learning how money works. And I think that's so important that I just run into a lot of young people that they don't understand how money works. You have the opportunity right now, and I certainly did this with my 3 kids when they were little. If we gave them money for chores, they earned money however they did it. But we'd say, hey, listen, you really, on top of our better bucket system as far as like a time-based investment approach, there's also kind of a 3-bucket system for how your dollars should be working like right now. I'd say like kind of within bucket number 1. Everyone should have like 10% that you set aside for the rainy day. You never know. Don't spend everything you make, and you're teaching Tori that right now. You should probably have a bucket of money that's just for giving. Maybe 10%. Yeah, and what is that for? Well, it's like when a friend at school has a birthday party and you want to buy them a gift, cool, you've got this giving fund set up because it always feels good to do something special for people, right?
Selfless act, if you will.
Yeah, we were talking about QCDs at the beginning of the show in hour number 1. So you should have 10% saved for you, 10% that you just give away and do fun stuff with for others. And then that remaining 80%, well, that's what you get to play with, Tori. When she's in middle school, high school, and she's wanting, a new outfit or get ready, bro. She's going to be like being asked to school dances and things like that. And so her and Tatum are going to go get dresses and all that. Hey, that 80% of yours, that's where you're going to do that stuff with. But you've checked the box, the 10% for you, 20% to give away and do good for others, 80% for you to have fun with.
Obviously, there's various routes that you can take. Call us, 979-59-MONEY. That's 979-596-6639. We come back. Let's talk about HSAs, MSAs, FSAs. What? Also, we got to talk about the markets, not too off all-time highs. We'll be right back.
Businesses today face a barrage of challenges. They hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. And putting together the right team to run your HR-related tasks can be expensive, let alone time-consuming. Enter Ataraxis PEO, your professional employer organization ready to tackle all your HR needs from payroll to benefits administration, payroll services, workers' compensation, and talent recruiting. They've got you covered. With Ataraxis, you gain access to a team of experts who handle the nitty-gritty of HR, freeing you up to focus on what you do best, growing your business and growing your revenue. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. So say goodbye to the stress of HR administration and hello to Ataraxis. Experience the power of a true business partner with Ataraxis PEO. Visit ataraxispeo.com. That's ATARAXISPEO.com. Ataraxis, elevating businesses for the benefit of all.
I know you've been waiting a little bit longer than normal.
Jen's manicure spot needs an extra pair of hands.
Who's at the front desk right now?
Someone who's handy with everything from nail files to spreadsheet files.
Deidre's not coming in today, but we have that whole bachelorette party.
Indeed can help her hire great people fast.
I need Indeed.
Indeed, you do. Instant Match instantly connects you with quality candidates whose resumes on Indeed match your sponsored job description. Visit Indeed.com/credit and get $75 towards your first sponsored job. Terms and conditions apply.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and then use tax-free for all of your qualified healthcare expenses. That's why you need Lively. Our favorite because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of the Real Money Pros.
Back to the Real Money Pros.
Welcome back to the Real Money Pros. Again, last segment, we got a little bit of time to take any calls. You have questions, we'll likely have an answer. 979-59-MONEY. That is 979-596-6639. Visit our website. Go to therealmoneypros.com. It's going to get revamped early next week. And we're really going to have some great visuals and a process that can help you get some insight onto our approach when it comes to managing money, the Better Bucket system, effectively solving for the proper balance between making sure you have enough liquidity, aka cash. You know a dollar needs to be worth a dollar the day you need that dollar. Let's determine how much. When you're in retirement, you're spending down that bucket one, that short-term bucket of money. Got to find some level of replenishment, making sure that your income bucket is properly fortified and solved for to make sure that your burn rate is sustainable on a monthly, quarterly, annual basis. And listen, when we're talking about longevity, you're likely going to have money that's in that third bucket, your growth bucket of money. Has a 10-year time window, meaning we can take on more risk. When it comes to any type of investment, when you're looking to get a reward or gain out of it, there's got to be some level of risk. It's that risk/reward balance. I don't care if you're investing. I don't care if you're in business and a business owner. That's just a part of the lay of the land. But this Better Bucket system allows you to solve for how much money you need. Because if there's one thing that I think investors run into is they identify themselves as I'm a risk taker or I'm too conservative or I'm in retirement, so I got to make sure that I can't lose anything. It's too vague. It's not solved for. You don't have true numbers behind how this whole thing coordinates with a plan. So we're really excited about this revamp of our website, and I'll kind of show you how that process is, how we operate and take that process with clients. And when you're looking at the markets, it's really interesting. I would say that even though we've seen some volatility over the past few weeks, you look at the S&P 500, it's up almost 17% year to date. You have the NASDAQ up over 22%, the Dow Jones up 13%. Good gains so far this year. And we've seen some turbulence over the past few weeks.
Oh, for sure.
Which is normal market behavior, by the way. However, the fact that we are basically right on all-time highs, this gives you a great opportunity to reevaluate and understand that if you need to take some chips off the table, how do you do it? How much, and then where do you stage that money? Well, that's where planning in the Better Bucket system comes into place, meaning there's just a better way to do this so you know that your money is a source of peace. Your money is a source of quality of life impact. If you don't have those two marks, again, great opportunity to reevaluate the plan. Maybe you're undershooting your targets, meaning if you've had growth investments and you've seen these bull market runs that we've seen over the past few years, how are you effectively capturing that versus just feeling good that you're seeing such gains in your growth bucket? It's like, well, what's the purpose? How can we increase quality of life? How can we maybe do some selfless acts? Meaning, let's let that tail wag the dog here. And again, this is a great opportunity. We're talking about end-of-year strategies, but if we're zooming out the lens here and we're looking at the full coordination of, maybe you got rental properties, you got real estate, you got public market investments, private market investments. How do these things all coordinate together for your benefit? And that's what we're here to do.
Yeah, I mean, for a lot of households, man, if you're up 17% year to date, I'm thinking you only live once. You can't take it with you. You've worked very, very hard to get to this point. Why don't you take that 17%, shave that off the top, and in 2026, go invest in making memories. Go do something like go hit a bucket list item with that 17% that the markets have provided for you this year. And maybe fast forward a goal or a life experience that you were thinking, I'm not going to have that until, 2027 or 2028. Man, you've probably delayed gratification long enough to finally get to the point where you are retired. Let's see if we can fast forward some of this stuff, fast track it a little bit.
Enjoy the fruits of your labor while they are still ripe. Like you can actually enjoy them. They're not turned sour. That is the sentiment that we're trying to give. If we're looking at the market, I mean, I've had some clients reach out, and obviously some headlines are really pushing out this concern that you're seeing an overvaluation. You're seeing this high concentration of just a few companies within these indexes. And if these companies, if they come under some volatility, that's going to drag down the rest of them. That's it. But however, you could argue that throughout history, we have seen that. We've seen individual companies that have taken the lion's share of weight in certain indexes. Now, is this time exactly the same? No. But again, even if we do see a scenario where maybe the market gets impatient, where you have these companies that are investing billions of dollars into their AI infrastructure, and investors eventually are going to say, well, you're investing all this money. We've valued your stock on the idea that your returns, your earnings are going to be higher down the line because of all this investment you're making in AI. If the market loses its patience and says, well, we're still not seeing that come through, yeah, we're likely going to see a pivot. We'll likely see some stock prices go down. We'll see some volatility. But again, what does that mean to you? Bring it back to the better buckets. Your growth money, a bucket, your growth money, your growth bucket, you're fine. You know you weren't going to touch that money for a 10-year period anyways. You can ride that out because you've already determined the timeline of when you're going to use your money. Your income bucket of money, as long as those investments are still producing income, we're in great shape. And your short-term bucket of money, your source of liquidity, well, that's not going to be subject to any volatility. I read this great breakdown of this individual who was archiving and taking us through his experience as he retired 2 months before the dot-com bubble.
Ooh.
He and his wife. They retired 2 months before the dot-com bubble, and then obviously they had they ran into 2007. And he was, effectively the whole approach of why they were able to ride that out is because they were following a version of the bucket system, right?
Which speaks to if we were going to use a technical term, that bucket system mitigated what we would call sequence of return risk.
Exactly. Sequence of returns risk is essentially this, that you retire and start having to live off your accumulated assets right when a bear market hits, meaning you're withdrawing out of these accounts that are at a suppressed level because it's tied to the market. Well, there are strategies, and again, a better way to protect yourself from that. And this doesn't involve some type of product that is the savior to this, where you can get market-like returns without losing any money. If it sounds too good to be true, it probably is, meaning this process, this system is solved for based on it's like a mathematical logic flow where you have a plan, you understand your inputs, your outputs, the tax liabilities that come along with that. When do you want to do certain stuff? When do you want to take that trip? How much is it going to be? How can we effectively look at the cost of living that's going to happen year over year for your future self? How do we look at the location of your assets, meaning Roth, pre-tax accounts, non-qualified accounts, meaning not held in an IRA? That's all part of your plan, and then you let those investments coordinate with the plan, which then you look at the timeline, aka the buckets, and then you can look at the actual allocation and investment makeup inside of those buckets. You can see how this is a flow. It's a process. I just talked with a client yesterday who, you could argue that there are ways out from retirement, but they were bringing up these questions, and I'm explaining the flow that we would need and really all the data we need to start gathering. But she said, well, is this like more of a formulaic thing? Like, and I said, no, this is a process. This is a process that we are going to take you to that is going to give us great insight into what decisions we need to make and what things we need to change. And ultimately, you understand it. You understand the why behind every move you're making with your money. So it gives you peace. Your money is a source of comfort, not unease or unknowing and having emotions tied to some headline that you're reading from some market pundit, right?
Yeah, I'll get people all the time at the gym, typically, but like they'll say
a lot of money conversations happen in the gym, Nick.
I know, it's great though. But they'll say, a lot of volatility in the markets lately. I'll bet all your clients have been calling you panicked, and I'll say, no, because they understand what we're doing for them, and it doesn't unnerve them.
Education and understanding. It's what the Real Money Pros is all about. Until next weekend. Thank you, Nick.
The Real Money Pros is hosted by Brian Wiley and other